Hi everyone, welcome to today's video collaboration between Bar Chart and Options Trading IQ. My name's Gavin McMaster. I'm the founder of Options Trading IQ, and I'm going to walk you through some information today on Iron Condors. Before we do that, just a reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So what is an Iron Condor? Well, an Iron Condor is an options income strategy that profits if the underlying stock or index stays within a certain range over the life of the trade. Over the course of any trade, stocks can move in one of five ways. They can go up a lot, up a little, they can stay sideways or flat, they can be down a little or down a lot. Stock investors, buy and hold investors, would make money in the first two of the above five scenarios. They basically need the stock to go up. The Iron Condor strategy will make money in the middle three situations, and sometimes, if they're managed well, can actually make money in all five of those scenarios. The ideal scenario, obviously, is if the stock or index goes sideways, certainly up a little or down a little, possible to make a profit. The trickier situations are when the market or the stock moves up or down a lot. So why trade Iron Condors? They have the potential to create consistent monthly income, no matter what the stock market does. They can be structured to be fairly high probability, and we'll talk about that more in a minute. Once you get the hang of them, they can be quite easy to manage. It can help avoid over trading, and they're non-directional, so we don't mind if the market goes up or down. We want to try and just profit from that sideways movement that happens quite a lot of the time. They're also short vega, which means they'll make money when volatility drops after placing the trade. A lot of the times in the market, volatility is overpriced, which makes it more advantageous to be an options seller. And that's where we create our edge, and Iron Condors take advantage of that phenomenon. So when it comes to probability, the majority of the time, a stock or an index is going to stay within a 1 to 2 standard deviation range. You can see here, roughly 68% of the time, it's going to stay within a 1 standard deviation move up or down. And around 96% of the time, it's going to stay within a 2 standard deviation range. So that's what we're looking to take advantage of here. Now, of course, there's something in the market called a fat tail, where we tend to get larger moves to the downside than what this normal distribution would indicate. So we do need to be aware of that, and that is one of the risks with the stock market, that it's not perfectly distributed. But this is basically what the philosophy is behind Iron Condors, that the majority of the time, the stocks and the indexes are going to stay within that 2 standard deviation range. So the first thing I like to do is to scan for stocks with high implied volatility. An Iron Condor aims to profit from a drop in implied volatility, with the stock staying within an expected range. When implied volatility is high, the wider the expected range becomes, so we can have a greater margin for error on a stock that has a high implied volatility compared to a stock with a low implied volatility. And we want to use things such as IV percentile and IV rank to try to gauge whether a stock has high volatility at the moment or low volatility. Now, you're going to have variances between certain stocks. You're going to have low beta stocks like consumer staples, Johnson & Johnson, for example, Merck, Pfizer, some of those stocks that don't move around too much. They're going to have a much lower implied volatility than something like Tesla or Roku. But what we want to do is compare the volatility of that particular stock to itself. We know that Johnson & Johnson is going to have a much lower volatility than Tesla. That doesn't mean Tesla is necessarily better for Iron Condors. It just means Tesla moves around a lot more than Johnson & Johnson does. So that range of the Iron Condor we can do on Tesla is going to be much wider, but we need that protection because the stock moves around a lot more. So what we want to do is we want to use IV percentile and IV rank to look at one particular stock and say, is the current level of volatility high for that stock or is it low? So we do that by IV percentile. And here we've got the scanner parameters that I like to use. So the first one I like to look for stocks with total options volume greater than 5,000. We don't really want to be trading stocks that have a low options volume because the bid-ask spread can be quite wide. It can be quite hard to get good fills on those stocks. The options are a bit illiquid. We want to be trading really liquid stuff that's really easy to get a good fill. Another filter I like to add is just market cap over 40 billion, just to, again, filter out some of those smaller cap stocks that might be a little bit more risky or thinly traded, and IV percentile above 70%. So we're going to try and find stocks that have a high current IV percentile. So here we have our list of stocks that meet those parameters. You can see some of our stocks with high market cap. We've got Apple, Microsoft. Apple in particular has a high IV percentile at 98% and also a high IV rank at nearly 93%. So we know that the current level of volatility in Apple options is much higher than it normally is. So that's how we can gain an edge and sell those options that are expensive compared to recent history. Some other examples there, and it might be good to look for stocks such as UNH that has a hold rating, or LLY 50% buy, Merck has a hold rating. Those are good examples as well where it's not a strong sell or a strong buy. We think maybe that's going to go a little bit neutral, but we're going to use Apple as our example because that's one that has a high market cap and really high volatility. So these are our results just from the stock screener. Then we go to our Iron Condor screener and we put in Apple as our stock symbol, and then we get our results. So the first example there has the short legs, the short puts at 140, the short call is at 160, and the spread is 20 points wide. So we're looking for the stock to stay between 140 and 160 between now and expiration, which is October the 14th. That has a 68% probability. The maximum profit is $3.29. That's the amount of premium that we receive for selling that Iron Condor. And the maximum loss is $16.71. So the profit potential is 19.69%. So let's take a bit more of a detailed look at that example. This is what it looks like in terms of our risk graph. So the blue line is our profit and loss graph at expiration. We want the stock to stay between 140 and 160 ideally. Our break-even prices are slightly lower at sort of 132 and 163. And the purple line is what's called a T+0 line. It just means, what does the stock look like as of today, the trade date plus 0 days? So when we enter the trade, this is how it looks. And I like to use the analogy of, we want to try and stay on top of the hill. You can kind of see that purple line. You can imagine that looks a bit like a hill. We want to keep the stock around that top of the hill range. So we want to set some price alerts. And I'm going to usually set those before it gets to the short strike of 140 on the downside or 160 on the upside. So I might set a price alert at 155 or 157 on the upside, and on the downside 142, 143, something like that. If those price alerts don't get hit, I'm pretty happy I can just leave the trade sitting there. If those alerts do get hit, then I might need to come in, look at the trade, and maybe perform some sort of adjustment, which is a bit more of an advanced topic. But there's various things that we can do to try to protect our Iron Condor as the stock is moving and we're starting to fall off either side of that hill. The other thing I like to do is sometimes narrow the width of the Iron Condor. So here we've got an Iron Condor that's 20 points wide. With one contract size, that's risking $2,000 less the premium received. The premium was about $390. Capital at risk is about $1,600 to $1,700, depending on what price we get filled at. So what I like to do is potentially change that to an Iron Condor that's only 5 points wide. I keep the same short strikes, 140 on the puts, 160 on the calls, but I bring those protective long puts and calls in a much closer, and that's reduced our potential profit from whatever it was, 320, 330, down to about 175. So it's cost us a little bit of premium to make that adjustment. But if you look at what's happened to our capital at risk, it's significantly reduced. Now we're only risking about $325, $330. So our risk to reward ratio is a lot better in this example. So there's a few tips for you on iron condors, what we look for when trying to find trades, how we set them up, and a little bit on trade management. I hope you've enjoyed the video. If you've got any questions, please leave a comment below or reach out to me on Twitter or on email. Have a great day, and I'll talk to you soon.